What is meaning of GST? The Goods and Services Tax, GST, is a comprehensive indirect tax imposed on the supply of goods and services in India. It is a value-added tax levied at every stage of the supply chain, right from the manufacturer to the consumer. GST was introduced in India on 1st July 2017. The GST system in India replaced multiple cascading taxes, such as central excise duty, service tax, VAT, and various state-level taxes, bringing them under one unified tax regime. What is main objective of GST? The main objective of implementing GST in India was to create a simplified and streamlined tax structure, promoting ease of doing business, reducing tax evasion, and fostering economic growth. GST is based on the principle of one nation, one tax, where a common tax rate is applicable across the country. What are the different types of GST? Under the Goods and Services Tax, GST, system in India, there are 4 different types of GST. Central Goods and Services Tax, CGST. CGST is a component of GST levied by the central government on intrastate supplies of goods and services. The revenue collected through CGST is retained by the central government. State Goods and Services Tax, SGST. SGST is another component of GST levied by the state governments on intrastate supplies of goods and services. The revenue collected through SGST is retained by the respective state government. Integrated Goods and Services Tax, IGST. IGST is applicable on interstate supplies of goods and services, including imports and exports. It is levied by the central government, but the revenue is shared between the central and state governments. IGST ensures seamless movement of goods and services across state boundaries, and it eliminates the need for separate central and state taxes on interstate transactions. Union Territory Goods and Services Tax, UTGST. UTGST is similar to SGST, but it is applicable in the Union Territories of India. The revenue collected through UTGST is retained by the respective Union Territory government. What are the different tax subs of GST? GST has different tax slabs based on the nature of goods and services. Under the Goods and Services Tax, GST, system in India, there are 5 tax slabs based on the nature of goods and services. These tax slabs are 0% tax rate. This tax rate applies to essential goods and services that are considered necessary for the general public. Some examples include fresh fruits and vegetables, milk, bread, healthcare services, education services, and transportation services. 5% tax rate. This tax rate is applicable to goods and services of basic importance. Some examples include packaged food items, textiles, footwear, hotels with room tariffs below a certain threshold, and small restaurants. 12% tax rate. This tax rate applies to goods and services falling under the general category. Some examples include processed food items, computers, electronic goods, mobile phones, and non-air-conditioned restaurants. 18% tax rate. This tax rate is applicable to goods and services falling under the higher tax slab. Some examples include air-conditioned restaurants, luxury goods, financial services, IT services, and telecom services. 28% tax rate. This tax rate applies to goods and services considered as luxury or demerit items. Some examples include automobiles, tobacco products, aerated drinks, high-end electronics, and 5-star hotels. It's important to note that some goods and services are exempted from GST or taxed at a lower rate based on specific notifications or exemptions provided by the government. The GST rates and classifications are periodically reviewed by the GST Council to ensure fairness and simplicity in the tax structure. How does GST work in India? GST in India is a value-added tax levied on the supply of goods and services. It operates on a destination-based consumption model. Under GST, businesses collect tax on their sales and claim input tax credit on purchases. The tax is then remitted to the government through a simplified online system. GST has replaced multiple indirect taxes, creating a unified tax regime across the country and promoting ease of doing business. What are the benefits of GST? And implementation of GST? Benefits of GST. Simplified tax structure. GST replaces multiple indirect taxes with a single tax, streamlining the tax structure and reducing compliance burdens for businesses. Elimination of cascading effects. GST eliminates the cascading effect of taxes by allowing businesses to claim input tax credit, resulting in a more efficient and competitive business environment. Seamless interstate trade. With the implementation of IGST, GST facilitates seamless movement of goods and services across state boundaries, promoting a unified market. Reduction in tax evasion. GST introduces transparency and accountability through the online system, reducing tax evasion and increasing tax revenues for the government. Promoting economic growth. GST aims to boost economic growth by promoting ease of doing business, attracting investments, and reducing logistics costs. Implementation of GST. The implementation of GST in India involved extensive planning and coordination between the central and state governments. The GST Council, comprising representatives from all states and the central government, was established to make key decisions regarding tax rates, exemptions, and procedural aspects. The implementation process involved migrating taxpayers to the GST system, updating IT infrastructure, educating businesses about the new tax regime, and ensuring a smooth transition. Multiple rounds of revisions were made based on feedback and practical challenges faced by businesses during the initial phase of implementation. What is the GST Council and what is its role? The GST Council is a constitutional body established under the Goods and Services Tax (GST) Act in India. It is comprised of the Union Finance Minister, who serves as the chairperson, and finance ministers of all the states and union territories with legislatures. The GST Council plays a crucial role in the decision-making process related to GST. The primary functions of the GST Council include tax rate determination. The Council decides the tax rates for goods and services under different tax slabs. It determines the rates based on revenue requirements, economic factors, and the impact on various sectors. Tax exemptions and thresholds. The Council decides on exemptions, thresholds, and special schemes applicable under GST, such as composition scheme for small businesses and exemption for certain goods and services. Dispute resolution. The Council resolves disputes between the central and state governments regarding GST implementation or any other related matters. Policy formulation. The Council formulates policies, guidelines, and procedures to ensure smooth implementation of GST, addressing the concerns and requirements of businesses and taxpayers. Decision-making. The Council takes decisions on various administrative and operational aspects of GST, such as rules and regulations, amendments to the GST Act, procedural changes, and modifications to tax rates. How is GST calculated? GST is calculated by multiplying the taxable value of goods or services by the applicable GST rate. The formula is GST amount is equal to taxable value GST rate 100. For example, let's assume the taxable value of a product is rupees 1000 and the GST rate is 18%. The calculation would be GST amount is equal to 1018, 100 is equal to rupees 180. So, the GST amount for this transaction would be rupees 180. The total amount to be paid by the customer would be the sum of the taxable value and the GST amount, which is rupees 1000 plus 180 rupees is equal to 1180 rupees. Can you explain the concept of input tax credit in GST? Input tax credit, ITC, is a fundamental concept in the Goods and Services Tax (GST) system. It allows businesses to offset the tax paid on inputs, purchases of goods or services, against the tax liability on output, sales of goods or services. In simple terms, businesses can claim credit for the GST paid on their purchases and utilize that credit to reduce the GST liability on their sales. This helps in eliminating the cascading effect of taxes and ensures that tax is levied only on the value addition at each stage of the supply chain. To claim input tax credit, businesses must fulfill certain conditions, such as possessing a valid tax invoice, using the inputs for business purposes, and filing their GST returns accurately. The ITC can be claimed for CGST, Central GST, against CGST, SGST, State GST, against SGST, and IGST, Integrated GST, against IGST. Input tax credit promotes transparency, reduces the tax burden on businesses, and encourages compliance. It is an essential mechanism in the GST system that facilitates a seamless flow of credits across the supply chain, benefiting both businesses and consumers. What is RCM? Reverse Charge Mechanism, RCM. Businesses liable to pay tax under the reverse charge mechanism, where the recipient of goods or services is required to pay tax instead of the supplier, must register for GST. What is payable GST? The difference between the output GST and input GST is the GST payable. What is input GST? Input GST refers to the goods and services tax, GST, paid by a registered taxpayer on the purchase of goods or services that are used for business purposes. It is an essential component of the input tax credit, ITC, mechanism under the GST system. What is output GST? GST on sales is called output GST, which is also referred to as GST liability. What is GST return? GST returns are regular statements filed by registered taxpayers with the tax authorities. These returns contain details of their sales, purchases, and tax liabilities. Various types of GST returns, such as GSTR1, GSTR3B, GSTR4, GSTR9, etc., are filed at different frequencies and provide a comprehensive overview of a taxpayer's transactions. What is GST evasion? GST evasion refers to the illegal practice of deliberately evading or avoiding the payment of GST by manipulating transactions, underreporting sales, inflating input tax credits, or engaging in fraudulent activities. GST evasion is a serious offense and can attract penalties, fines, and legal consequences. What is GST liability? GST liability refers to the amount of tax that a taxpayer is legally obligated to pay to the tax authorities based on their taxable supplies. It includes the tax liability on outward supplies, sales, and the liability to reverse input tax credit, if applicable. What is GST audit? GST audit is a process conducted by tax authorities to verify the accuracy and compliance of a taxpayer's GST records, returns, and financial statements. It involves a detailed examination of the taxpayer's books, records, and supporting documents to ensure adherence to GST laws and identify any discrepancies or non-compliance. What is GST compliance? GST compliance refers to the fulfillment of all legal obligations, rules, and regulations related to GST. It includes timely registration, accurate filing of returns, payment of taxes, maintenance of proper records, and adherence to other compliance requirements specified by the GST authorities. What is GST fraud? GST fraud refers to deliberate and intentional acts of deception, manipulation, or misrepresentation by taxpayers to obtain unlawful benefits, evade taxes, or claim fraudulent input tax credits. GST fraud undermines the integrity of the GST system and can lead to severe penalties and legal consequences. What is GST refund process? The GST refund process allows eligible taxpayers to claim a refund of the excess tax paid or accumulated as input tax credit. Taxpayers can file refund applications along with supporting documents, and the tax authorities review the application to determine the validity and process the refund if approved. What does GST taxable event mean? In the context of goods and services tax, GST, the taxable event refers to the specific event or transaction that triggers the imposition of GST liability on the taxpayer. It is the occurrence that makes a supply of goods or services subject to GST. What is GST transition provisional? Transition provisions under GST are temporary rules and regulations that apply during the transition period from the previous tax regime to the GST system. These provisions address issues related to input tax credits, tax payments, and other transitional matters to ensure a smooth transition to the new GST regime. What is GST composition? GST composition scheme is an optional scheme available to eligible small businesses with a turnover below a specified threshold. Under this scheme, taxpayers pay tax at a fixed percentage of their turnover and have simplified compliance requirements. However, businesses opting for the composition scheme are subject to certain restrictions and cannot claim input tax credits. What is QRMP under GST? QRMP stands for Quarterly Return Filing and Monthly Payment of Taxes under GST. It is a scheme introduced by the Goods and Services Tax Network, GSTN, to simplify the compliance process for small taxpayers. Under QRMP, eligible taxpayers file their GSTR1 and GSTR3B returns on a quarterly basis while making monthly payments of tax liability. What is limit of GST HSN code? The limit of the GST HSN, Harmonized System of Nomenclature, code in India is a 6-digit code. The HSN code is used to classify goods and services for the purpose of GST. However, it is worth noting that certain goods may require a more detailed HSN code with 8 or 10 digits, depending on the turnover and other criteria specified by the government. The use of a more detailed HSN code allows for more precise categorization of goods and facilitates accurate tax calculation and reporting. What is the GST number? How is a GST number assigned? The Goods and Services Tax Identification Number, GSTN, is a unique identification number assigned to each registered taxpayer under the Goods and Services Tax, GST, system in India. It is a 15-digit alphanumeric code that serves as the identification number for a business or individual registered under GST. The structure of a GSTN is as follows. The first 2 digits represent the state code as per the Indian Census 2011. The next 10 digits are based on the permanent account number, PAN, of the taxpayer. The 13th digit indicates the entity type of the taxpayer, such as individual, company, partnership firm, etc. The 14th digit is reserved for future use. The 15th digit is a check digit for validation. The process of assigning a GST number involves the following steps. Registration. The taxpayer must apply for GST registration online through the GST portal www.gst.gov.in by providing relevant details and supporting documents. Verification and approval. The application is verified by the tax authorities, and if the information provided is correct and complete, the registration is approved. Generation of GSTN. Once the registration is approved, the GSTN is generated and issued to the taxpayer. The GSTN serves as a unique identification for a taxpayer and is used for various GST-related activities such as filing GST returns, raising tax invoices, and claiming input tax credit. What do you understand by the remission of tax duty? The remission of tax duty refers to the process of exempting or reducing the amount of tax or duty payable on specific goods, services, or transactions. It is a measure taken by the government to provide relief or concession to certain sectors, industries, or individuals. The remission can be temporary or permanent, depending on the circumstances and policies. It aims to promote economic growth, incentivize specific activities, or mitigate financial burdens on certain entities. Remission of tax duty is usually implemented through legal provisions, regulations, or administrative mechanisms. Can you explain the concept of a place of supply under the GST? Under the Goods and Services Tax, GST, system, the concept of a place of supply determines whether a supply of goods or services is considered an intrastate supply or an interstate supply. The place of supply is significant in determining the applicable tax rate, CGST and SGST UTGST for intrastate or IGST for interstate, and a jurisdiction for tax collection. For goods, the place of supply is generally the location where the movement of goods concludes or where they are delivered to the recipient. For services, the place of supply is determined based on specific rules depending on the nature of the service. It can be the location of the recipient, the location of the service provider, or another specified criterion. What are the common different forms for GST? Under the Goods and Services Tax, GST, system in India, various forms are prescribed for different purposes related to GST registration, filing returns, and other compliance requirements. Here are some of the common forms used. GST Reg 01, application for GST registration by taxpayers. GST Reg 06, application for the amendment or modification of details provided at the time of GST registration. GSTR 1, monthly quarterly return filed by registered taxpayers furnishing details of outward supplies, sales, made during the period. GSTR 2A, auto-populated form generated for recipients based on the details furnished by the supplier in their GSTR 1. GSTR 3B, monthly return summarizing details of inward and outward supplies along with the payment of tax. This form is currently used for provisional assessment of tax liability. GSTR 4, quarterly return filed by taxpayers opting for the composition scheme. GSTR 9, annual return filed by regular taxpayers, providing a summary of the entire year's transactions. GSTR 9C, reconciliation statement and certification by a chartered accountant or cost accountant for taxpayers above a certain turnover threshold. GSTR 11, form for taxpayers with a unique identification number, UIN, to claim a refund for taxes paid on inward supplies. What are the GST registration requirements? Under the Goods and Services Tax, GST, regime in India, businesses are required to register for GST if they meet certain criteria. The GST registration requirements include threshold turnover. If the annual aggregate turnover of a business exceeds the prescribed threshold, GST registration is mandatory. The threshold limits are different for goods and services. A. For businesses in most states, rupees 40 lakhs for goods and 20 lakhs rupees for services. B. For businesses in special category states, rupees 20 lakhs for goods and 10 lakhs rupees for services. Interstate supply, businesses engaged in interstate supply of goods or services, regardless of turnover, must register for GST. E-commerce operators are required to register for GST, regardless of turnover, if they facilitate the supply of goods or services through their platform. Input service distributors, businesses acting as input service distributors, ISD, who distribute credit of input tax paid on services to other units under the same PAN, need to register for GST. It's important to note that certain businesses, such as casual taxable persons, non-resident taxable persons, and agents of a supplier, are required to register for GST irrespective of turnover. To register for GST, businesses need to provide relevant documents and details, such as PAN, permanent account number, address proof, bank account details, and business-specific documents. The registration process can be done online through the GST portal. www.gst.gov.in by filling the necessary forms and submitting the required information. Proper GST registration ensures compliance with the GST laws and enables businesses to avail input tax credit, collect GST from customers, and fulfill other tax-related obligations. What is the GST registration threshold limit? The GST registration threshold limit is the prescribed turnover threshold above which businesses are required to register for goods and services tax, GST, in India. The threshold limit varies based on the nature and location of the business. For businesses operating in most states of India, the GST registration threshold limits are as follows. For goods, the threshold limit is rupees 40 lakhs of annual aggregate turnover. This means that if a business's annual turnover from the supply of goods exceeds rupees 40 lakhs, it must register for GST. For services, the threshold limit is rupees 20 lakhs of annual aggregate turnover. If a business's annual turnover from the supply of services crosses rupees 20 lakhs, GST registration becomes mandatory. However, it's important to note that there are special category states in India where lower threshold limits are applicable. For businesses operating in these states, the following threshold limits apply. For goods, the threshold limit is rupees 20 lakhs of annual aggregate turnover. For services, the threshold limit is rupees 10 lakhs of annual aggregate turnover. Who is not eligible for GST registration? Some of the goods and services exempt from GST include non-taxable goods like petrol and alcohol for human consumption are not subject to GST. Goods supplied to CEZ developers or special economic zones fall under the GST exemption list. Items included in the zero-rated list, meaning that their fixed tax rate is 0%, are free from GST. Transport facilities such as public transport, metered cabs, auto rickshaws, metro, etc. Shipping of farm produce and goods outside of India. Transportation of goods where the total cost is less than Rs. 1,500. Governmental and foreign diplomatic services. Who is eligible compulsorily register for GST? Casual taxable persons. Non-resident casual taxable persons. Persons making any interstate taxable supplies. Agents acting on behalf of a registered taxpayer. Persons conducting business in a state other than the one they are located in. Persons who sell products on e-commerce sites such as Amazon and Flipkart. E-commerce operators. TDS/TCS deductors. Persons subject to reverse charge taxation. Individuals working in the import-export industry. Businesses registered under previous taxes such as VAT, excise, and service tax. Individuals running an aggregator company. Input service distributors. OIDA, Online Information Database Access and Retrieval, service providers in India.